It's Market Day Report. Welcome to, well, I think Cow Guy calls it a synthetic Friday because we trade today, take tomorrow off, and then we come back in on Friday to trade again. So we've got a 4-day trade week, and that's what we're looking at. All right, when we look back at how the markets ended the day yesterday, one market that really saw a boost higher was the soybean market. Let's start there as we look at the overnight trade action, and November slipped a penny and a quarter to 1066.5. Soy meal in the overnight session was lower as well. Now, both of those were higher in the session yesterday, but soy oil was lower yesterday. We saw a little bit of strength in the overnight action. Let's hit corn before we roll back into the wheat market. In December, penny and a quarter higher at 440. Now to the wheat market. July, Chicago up 3 overnight, 552 a bushel. Hard red up 3 3/4, 551.5. Spring wheat, December contract gains 3 3/4 cents, 665 3/4. And in the overnight action, cotton 74 lower, 66.81. Let's go to Springfield, Missouri. President, Midwest Market Solutions. It's Brian Hoops. Brian, welcome back. And what are you watching today?
Hey, good morning, Tony. Well, of course, we have a abbreviated session, as you mentioned, with markets closed tonight. They will reopen the grain markets anyway Thursday evening, and livestock at 8:30 on Friday. So a little bit of an abbreviated session, but normal time closed today. Looking at the grain markets, it's kind of been the soybean oil and soybean show here. We've seen big rallies in new crop soybeans, and I think that's because we're putting in a risk premium. We have really slow planting or harvesting pace, of the winter wheat crop. We're about 10% done nationwide. We should be closer to 27% done. And if you look at places like Southern Illinois and Indiana, we are the slowest harvest pace in over 10 years. There's also a tendency to plant double crop soybeans in those areas after the winter wheat harvest. So farmers right now need that incentive of higher prices of November beans to go ahead and plant those beans in the month of July, because that looks like when a lot of that crop is going to be harvested in the wheat, and then in the case of soybeans being planted directly afterwards. So they need that incentive to make sure that they go ahead and plant it. There's a lot of areas that have had too much rain that are just real slow as far as planting, and so they want to the market's providing that incentive to plant those soybeans a little bit later rather than take a prevent plant crop this year, because we are expected to plant a lot less soybeans compared to a year ago. If you look at the weather, though, corn and soybean development should be nearly ideal through the end of the month. We only have about 7 trading days left until that June 30th acreage and stocks report. That's going to be a very key market moving report. And with weather forecasts looking good, I think it's going to be hard to really sustain a rally in corn. Soybeans have a reason to rally, but the wheat market, it's tried to come off its lows and rally with a weather premium being thrown in. But again, harvest is just really getting started here, and you would think that there's going to be some harvest pressure weighing on prices because this crop is going to be probably a little bit larger than what a lot of people expect.
Speaking of a rally, I don't know what I guess if you're talking losses, you can have a rally in losses as well. One area that we don't really expect that to happen has been the cattle market, yet live cattle down 5 out of the last 6 sessions. We'll take a break, and when we come back, we'll pick that conversation up with Brian Hoops. Market Day Report continues in a moment. Cattle on feed report set to come out on Friday after the close, 3 p.m. Eastern time. So we'll take tomorrow off. We'll trade all day Friday before the report. Report comes out, and then we'll wait till Monday to, start trading the report. However, this is what we traded yesterday, lower trade for live cattle. That's right, 5 out of the last 6 sessions have actually been lower, down $4 on the June at 223.02, and August down 5.20 at 210.35. Feeders getting in on some of those losses yesterday as well. 722 lower on the August at 303. September lost 705, settling 302.52. And even with the losses, still holding on to that $300 range from August through October. And the hog trade yesterday was lower as well, down 97 on the August, 111.70. Brian Hoops is with Midwest Market Solutions. All right, do we call that a free fall?
You could, I think. It's been kind of ugly in the cattle market. As you mentioned, 5 out of the last 6 sessions, we've been lower. Now, this morning, there's not a lot of selling showing up quite yet. It may show up right before the opening in here, but the cutout values were sharply higher last night, over $5 gains in the choice. Select is higher as well. And so what this is going to do is improve our packer margins. Now, cash trade went from being stayed to higher to being stayed to lower as far as our calls go for this week. There was a handful of trade at 229 in Kansas yesterday. That'd be about $1 lower. So that helps restore these packer margins. They're now estimated to be in the red, $74. So there is a benefit here to this softer cash trade that we're probably going to see this week with the cutouts being higher. A lot of this has to do with concerns about inflation and what's going to happen this summer and the rest of our summer here demand season. We are past the Father's Day holiday. 4th of July holiday, another big grilling holiday just around the corner. Then after that, it starts to slow down from a seasonal standpoint. And the market's looking ahead and thinking if we have a war and crude oil prices, gas prices skyrocket, there's going to be a lot of inflation that the consumer has to spend money on different items rather than buying beef and higher price proteins. That's going to be a concern. It's going to take the probably top edge of this market off in here. Although the supplies are going to remain tight, it's going to really stretch the fundamentals out in here. Tight supplies, higher cash trade, higher cutout values versus potentially softer demand from the consumer. So yeah, we could see some really wide ranges in here as we go into this midsummer timeframe.
Brian, great to see you. Thanks for the insight. Brian Hoops, Midwest Market Solutions. He mentioned the summer grilling season. What about the summer driving season?